Have you ever wondered if there is a tiny, often overlooked fee that could silently eat away at your investment returns over time, almost like a financial slow leak? It is something many investors do not fully grasp, but understanding it can make a real difference in your wealth-building journey. You should pay attention to investment fund expense ratios all the time, because they representing a direct cost to your returns, but they become absolutely critical when you are comparing similar investment options, especially for long-term goals or when choosing passively managed funds like index funds and exchange-traded funds. An investment fund expense ratio is simply the annual fee a fund charges as a percentage of your total investment. This fee covers the fund's operating expenses, such as management fees, administrative costs, and marketing expenses. This percentage is deducted from the fund's assets before returns are calculated, meaning it directly reduces the money you earn. Over decades, even a small difference in this percentage can amount to tens of thousands of dollars in lost growth, because it is not just the fee itself, but also the compounding returns you miss out on by not having that money invested. To practically apply this, always locate the expense ratio before investing in a fund. You can typically find this number clearly listed in the fund's prospectus, on the fund company's website, or through financial research tools. Compare this ratio across similar funds. For example, if you are looking at two different S&P 500 index funds, and one has an expense ratio of 0.03% while the other is 0.15%, the lower cost fund will likely deliver better net returns over time because they track the same underlying index. Understanding the concept of basis points can further refine your attention to these fees. 1 basis point is equal to 1/100th of 1%. So, a 0.03% expense ratio is 3 basis points, and 0.15% is 15 basis points. Many low-cost index funds and exchange-traded funds now boast expense ratios in the single or low double-digit basis points, which is a testament to the competitive nature of the fund industry and a huge win for everyday investors. Paying close attention to investment fund expense ratios empowers you to keep more of your hard-earned money invested and growing for your future. By actively seeking out and choosing funds with lower expense ratios, you are not just saving pennies. You are optimizing your portfolio for greater long-term compounding, ensuring that more of the market's returns end up in your pocket.